to jump into this, I just want to thank especially Lindsay and Jesse and Caroline for helping create all this content and organizing everything. They've been a true force in putting this all together. So thanks to them. And then I'll introduce our guests in a little bit, but also thanks to them and the whole concept of this. And this is our maiden voyage of this real estate roundtable idea. Is our whole concept is to create some topical ideas that can be presented in a more comprehensive fashion. And I really wanted to create something that I feel like I would be interested in. So I'm pulling in really what I consider true industry leaders in their respective fields. So we've got lender, construction, residential, and commercial real estate represented here. And the topic of today's conversation is really related to, here we are a year post-COVID, post the origin of COVID, and what's changed, what's happened, and what do we see looking forward. So the agenda is I'm going to do a little brief introduction that I've prepared, and then we're going to each respectively talk about our areas of expertise. We'll then have a little wrap up and a little bit of Q&A. And so I'll jump right into it. So if we flash back about 12 months, COVID was somewhat of a new topic of conversation. I remember my daughter's birthday party, or 17th birthday party, was pretty much the last social event I think I've gone to. And now we're a year later, lockdown was about to begin. The real estate market was entering into its typical busy season when all showings essentially ceased to exist. Real estate forecasters were predicting as much as a 40% decline in value and sales nationally, and the industry was bracing for what was going to be a very dark period. Over the next 45 days, showing activity in Colorado declined as much as 93%. All those forecasts were becoming a reality. Real estate, shortly after, was then defined as an essential service, and restrictions began to ease. COVID has taught us that we can work from home and asked us to realign some of our priorities, both in life and largely in our housing needs. The gates to lifestyle communities like Boulder were opened, and the migration of the wealth of largely driven by some of the more fortunate or the wealthy from urban centers like New York, San Francisco, and LA began. The months to follow were some of the busiest I have witnessed in our market. And I believe that our market has sort of forever been redefined. Yes, national markets have suffered greatly, but as with much of the pandemic, the impacts have been targeted, with tremendous prosperity and growth offset by great loss. So that's the preamble to this conversation. And what I'm going to do is I'm going to quickly first talk about the residential market, and then we're going to jump into some of the other topics. So again, just another introduction. I won't dwell on this too much, but it's largely covering what I just discussed. So first, I'll just introduce our industry experts. There's me. I'm covering the residential piece of this. Scott Crabtree is with the Colorado Group, and again, I sort of chose people that I truly believe are defining people in their respective fields of Boulder's real estate market. So I really believe that all of our industry experts are exactly that. They are the market makers in this area. So I'm just as curious to hear what they have to say as you are. Then we got Adrian Wise. So his last name might be the hardest to pronounce, but it's Wisniewski. Am I correct, Adrian?
Perfect. Nice job.
Perfect. So Adrian is one of the lead project managers at Melton Design and Build, and I'm sure many of you are familiar with Melton and have worked with them in the past, but they are sort of one of the premier build design firms in this market. So Adrian's going to cover a great deal of topics related to the changing needs, supply chains, stuff like that, as it would relate to construction. Let's see, where did I? Noel Bennett. Noel is a mortgage broker with Premier, and he's a native Boulder resident, has grown up here, and is one of the heads of Premier Mortgage here in Boulder, and is a wealth of knowledge. So I'm looking forward to hearing what he has to say. Okay, so I'll just jump into our topics here. As I said earlier, this is the very beginning of, you can see the big dip. So what this slide represents is the showing activity in Boulder since marked over a 3-year time period. And you can see that huge dip is right when the shutdown was announced. So COVID, we declined as much as 92%. I know everybody was bracing for a tough time. We very quickly recovered, and you can see that the trend sort of followed the typical year. And you can see on the left side, the orange line is 2021. And we've sort of exceeded and followed on pace with that. There's something that I think this taught me something. I was operating under the presumption that there is so many more buyers in this market. And the real conversation to be had, which we'll have later, is more related to the lack of supply, the lack of listings, because you can see the number of showings to me directly correlates with the number of buyers, not directly, because with lower inventory, there's less to see and less showings, but the number of buyers has gone up, but not exponentially so. What has really been most impactful is the limited number of houses for sale. And I've got a slide that'll represent that. Again, we headed into COVID, a little humor from the movie The Shining. This slide shows us what has happened recently, and it's a deck that shows July to December total sales, and you can see total sales were up 31%. That's pretty unprecedented. The average sales price, and again, this is across the entire market, is up 3.4%. And then the days on market is down 27.7%. So pretty profound numbers. And the impacts on the market have been very targeted. When we talk about the average sales price being up 3.4%, that I don't think is totally illustrative of the changes in the market. We've had a whole new segment of our market that didn't exist before. And to me, that whole new segment is sort of the ultra luxury market. Preemptive of COVID, there were only a handful of sales of homes north of, let's just say north of 3.5 million. And now that's commonplace. And we're seeing sales, upwards into the 7 million category that are not that rare. Much of that market is happening off the market, but we're seeing significant sales that our market has never seen before. So this to me is a whole new category of market that's opened up. So like everything, the $1 million market is every house that comes on the market has multiple offers. So it's been fairly segmented, but the market in general, especially over the last 2 months, has been tremendously competitive, with many, many buyers fighting for a very limited inventory. Current market, as you can see on the right-hand side, really, this is just charting the number of active listings. And you can just see how pronounced the inventory shift is relative, dating back all the way to 2017. We're so low in inventory, and that's really what's pressing prices up and keeping the demand high. So that's a fairly significant shift. Again, this is highlighting active listings being down up to 50% as compared to January of last year. I don't know that we've ever seen that market dynamic before. And that's across all market segments. All areas in Boulder County have seen similar results. Average sales price in January increased by 17%. Again, I don't know that I've seen a month in Boulder real estate history where the average sales price has jumped 17%. in a single month as compared to a previous year. But again, a fairly impactful change. Average days on the market is down as 27%, looking at January's. So that again just shows the demand and the increase in demand. It's funny, the sentiment, it wasn't that long ago that we would feel lucky to get an offer. And again, in certain price points, certain markets, especially focused on the in-town market, that's where much of the activity has been driven. A full price offer is now, asking price is simply just a suggestion in this market right now. I'm seeing houses sell for as much as 10 to 15% above asking prices, with as many offers as, I've seen as many as 15 to 20 offers, sometimes 3 or 4, but still tremendously competitive. So it's a shifting market every day. Okay, so now we're going to segue to our guests. Noel, why don't you lead the charge, just because you're the next deck up. So.
Perfect. Well, I don't know if, one of the questions I was asked is, what has been the biggest impact of COVID on lending? And Steve, like you, I remember so clearly a year ago, and I was predicting pretty quickly the demise of my career, and what else am I going to do with my life? And and then I started realizing rates were plummeting, and started feeling a little more optimistic. But then we started losing investor after investor, especially on the jumbo side. So we had investors pulling out of the market, even loans that we had locked. In certain cases, we weren't able to pull through, and we had to find alternatives. So that was a very scary couple months there. Then they, things started to, I think everyone was aware that it became our new reality, and some of these investors came back in. Some still haven't, actually. But the biggest impact, I think, that we see today is self-employed borrowers are really impacted right now. And what I mean by that is it's way more invasive process to get a mortgage when you're self-employed, in terms of we have to get right up to date profit and loss statements from the business. And as well, we have to get, now they've just increased it across the board pretty much to 3 months of business bank statements. So we've got to not only show the P&L for the year or year to date, we've now got to show 3 months of business bank statements showing deposits going in that would justify those numbers on the P&L. And that's fully COVID driven. That's new. We've never had to do that before. So it's made jumbo, especially jumbo self-employed borrowing, just more invasive and a little more difficult. Well, quite a bit more difficult in certain circumstances. Other than that, I would say, we are seeing a lot of appraisal waivers on the conforming loan side. So we're getting more and more of those where we don't even need an appraisal for a transaction. So in some sides it's loosening up, and other sides it's more difficult.
Why, Noel, are you seeing appraisal waivers? Are the money sources simply more confident in the market than they had been in the past?
I think that, so the appraisal waivers always come from the Fannie Mae or the Freddie Mac automated underwriting systems that we run all those types of files through. And I think what's happening, Steve, is that, they've just built these bigger and bigger databases of comps and sales in the area. So as they have those bigger databases they can access, they start feeling more comfortable with values as stated. And of course, a lot of these, you won't often see an appraisal waiver with less than 20% down. As you put more money down or on refinances with more equity, we're starting to see them just be more comfortable with the value that we're stating. Because I think those systems are basically cross-referencing all these other sales that have happened, and these databases just keep getting more robust that they can access. So I think that's the answer.
Are you seeing an increase in any specific buyer type, investor buyers, second home buyers, or are we still primarily focused on just regular old single family primary residence buyers?
Well, the biggest type of buyer we're seeing is desperate, but I'm kind of kidding. I think that you're right. Like I've seen, especially in the last, I would say 4 or 5 months, a lot more wealthy or people with high incomes coming from coastal areas, and in particular, Google folks or those types buying here. I just had one that was buying an investment property here over $1 million. And so I think that, yeah, we're definitely seeing that. We're seeing a lot of people look in the mountains too, at condos and townhomes, second homes up in Vail or Silverthorne, those types of places. So back to that theme that you mentioned, Steve, of like people wanting to have at least an escape from a big city. So I've seen that quite a bit. And it also really pointed out to me the tale of two economies that we've got going on that you referenced. And in that, COVID hit some industries really, really hard and just destroyed them. And on other industries, it wasn't impacted at all, or in some of them got even better, like, you know, things that are tech driven and such. So, but both types of buyers, definitely more second home and investment buyers, and a lot of wealth from the coast, I would say.
It's interesting, Noel, you bring up the mountain markets, and anecdotally there, I had a little information about the mountain markets. Aspen and Telluride is a really good example that they are nearly $1 billion greater in sales than they were in the last year already.
Yeah.
And their school enrollment has shifted. It's typically 30 to 35 students enrolled in any given school, and now it's 150 new students. So really what that highlights is that we've got these buyers that are moving to to these luxury communities that simply didn't exist,
Yeah. Yeah. It feels like if you can afford to get out of the cities, then people were doing it or still are doing it.
Yeah. So the big question, Noel, is where do you see interest rates going? What's the forecast?
Well, there's a little graph on the screen, and I just did a little snippet of this was yesterday, but so this is mortgage-backed security pricing, and we want to see pricing going up for the prospect of lower or even steady rates. And you can see that's been the opposite, especially starting in kind of February. We've seen pricing just go down and down, with a couple good days here in March and then back down again. So this means, so rates, and everyone's probably heard this, rates have gone up. We're up maybe 0.5% since where they were the low points of COVID. Mm-hmm. And frankly, the person that I follow most closely, who's been fairly accurate through all this, believes that rates are going to continue to go up in a stair-step fashion, at least for the next 2 to 3 months. It gets pretty murky after that. We do think that, we are on track for a recession in 2022 or maybe 23. Of course, it's hard to predict when, but the fiscal withdrawal from the government, that will start to happen unless they change policies or something. And that should be a signal for the potential recession. Recessions are good for mortgage rates. So does that happen late this year, or does it move into next year? That part's hard to know, but I do think we're in for heavy volatility for the next few months, with a general bias towards upwards. And the longer term, I feel pretty comfortable that rates could be even lower than where they are now, or as low as they are now. So people buying in this, next few months may have an opportunity to refinance in the future. All this should be the framework should be that rates are still very, very low, like near historic lows. So to say rates are high, I had someone call me just today and said they read an article that rates are quite high right now, and that's laughable. They're very low in a historic sense, and jumbos are very low too. So we don't know, but I do think we're going to see a lot of volatility for the next few months, and probably up.
All right, Noel, anything more to add before we move on?
I don't think so, Steve. I think, I was really interested to see what you said about the residential market. It tracks exactly with what I'm seeing on the loan application side. I've found myself writing pre-approval letters, sometimes for 3 or 4 different clients for the same property. And that's always an indicator to me of the lack of inventory out there. One thing I will add is, people ask me, are we having appraisal trouble when we do need appraisal? Not yet. I would say, I'm going to knock on wood right now, but we haven't seen a lot of appraisal problems hitting value, even though most of these or many of these properties are going over asking price. Yeah. So I think that's a good sign. And, it supports the fact that we have a lot of appreciation happening right now.
It's an interesting comment on appraisal. Appraisers tend to look backwards they tend to look at the past while the market tends to look forward. And when it comes to pricing, or at least they don't look back nearly as far, and they tend to push forward a little bit. So it's a little surprising that we have not seen any appraisal issues. And I would share that sentiment. I have not had any appraisal challenges as of yet.
Yeah.
Yeah. Okay. Thanks, Noel. That's great.
Yeah, thank you.
Let's segue to Scott. And again, for those that don't remember, or for those that entered late,
I remember you said that.
that was Noel Bennett with
I
Premier
talked
Mortgage.
about that. I wanted to do that, but we didn't end up doing.
And then there's Scott Crabtree with the Colorado Group. Scott is one of the, what I consider one of the premier commercial brokers in this market. And obviously commercial has been affected in very different ways than our residential market. So I'm very curious what Scott's reflection on the last year and then projections forward will be. So Scott, if you want to just take it away for a bit.
Sure. Thanks for your interest, Steve. Thanks for having me on. I think probably going into COVID, people thought that commercial real estate is going to be a big doom and gloom. And there certainly are areas of it that has been true for. And, looking at a national level, I would say Boulder's a little bit of an anomaly to maybe the rest of the country, or, even the world. So I'll focus a little bit today more specifically on Boulder, but happy to answer questions nationally as well. Biggest impact was another question that I was posed by Compass. And, really we have to take that sector by sector within the commercial real estate asset classes. Office and hospitality are the two assets that got hit probably the hardest during this. Specifically for Boulder, we were probably at the peak of our market, and it was rolling really well. Rates in downtown Boulder were reaching 40, and some of the new projects in central Boulder reaching $40 triple net base rent. So, that has definitely taken a little bit of a step back. But I do believe that coming this summer and into the fall, we're going to see that market come back relatively quickly. And I believe within the next 18 months, we'll probably be tracking right back to where we were. There's a lot of factors that still need to play out, and that's the work from home component of all this. But with that said, it's, we typically track behind residential 12 to 18 months. And I think that's going to happen a little faster just with the influx that we're having from the coastal markets. And so, with the lifestyle that people are chasing here and all the amenities that Boulder offers, the companies and the jobs are going to be quickly coming behind that. So I think we are going to see some of the bigger tech companies shifting to taking more space and kind of figuring out what their needs are going to be. But that may not be true across the board. I think San Francisco, who a couple months prior to the pandemic starting, had just surpassed New York with the highest rents, is the market that is getting hit the worst right now. So San Francisco, New York, Chicago, Boston. And we're seeing a lot of those companies that already had offices here, satellite offices, and now a lot of their employees are choosing to move here. Google's new campus is the #1 requested transfer in the world for Google here in Boulder. So we're going to see those campuses, maybe they're going to get smaller in some of the cities like San Francisco, New York, and probably get larger in places like Colorado, Boulder specifically, and Texas, who's getting a lot of traction as well right now. So I think the office is going to have a relatively quicker recovery than people think. And, the work from home scenario is still to be determined, but I think end of the day, people are going to want to have places to go, and whether that's part-time, full-time, how they rotate through that, that's what we're still waiting to see how that plays out. Hospitality, we don't have a ton of it here in Boulder, but there's a pent-up demand for people to get out and travel and want to be going places. So I think once the vaccine settles in, we'll probably be seeing that as well this summer and fall come back. some of the part for office that isn't going to get backfilled, we're already seeing a transition to life science, which is an industry that was here in Boulder 10 years ago and sort of left to California and Boston. And we're already seeing that come back in. And some of the investors that are coming behind that and buying office and industrial buildings and converting those over, they're paying top dollar in Boulder to chase these life science tenants. And that's going to be an industry that we didn't have, for the past couple of years pre-pandemic, that's going to be coming back around. Retail was a big one. People walk down Pearl Street, everything's closed down. You see signs everywhere. Everyone's saying to me, oh, retail is going to get killed during this, restaurants, all of that. Yeah, there's going to be a changing of the tenancy down here, but we're getting a ton of transactions done on the retail side. The east end of Pearl has seen a big movement in with outdoor companies. Rates really haven't taken a huge dip. We're already seeing deals transacting right where they were pre-pandemic. I think there was some percentage rent or some free rent periods that happened during the pandemic time when landlords wanted to get people in their spaces. And then on the restaurant side, the companies or the businesses that weren't doing well were going to fail anyhow during that time. The landlords let them go. But the businesses that were doing well, I think most landlords were smart and they figured out a structure to keep those tenants in place. And so it's just a matter of time. And same as hospitality, when we can get back out and people are already starting to, I think there's going to be a pent-up demand for people to get back into the restaurant spaces. So it really hasn't been that doom and gloom. And our vacancy on Pearl, I would argue, is probably only a few percentage points off of where it was going into this. So it's not going to be that big of an issue. Industrial, that sector has never been hotter, and there's just not that much of it left in Boulder. So there's multiple offers on every vacancy within Boulder right now. That asset class trading on the sales side, there's just so much money coming from both coastal markets into here chasing that. And so to kind of round that out, the investment sales and just the sale market for owner users with where the rates are and what Noel was talking about. If you look at a lease versus own scenario, if people have the capital to put down, probably the majority of the transactions that we're getting done right now and over the past 6 months have been on the sales side, and that volume has never been higher. We just have a supply issue of what is out there for investors and businesses to buy right now.
What do you see? Shared workspaces pre-COVID were such an incoming and popular theme. Are you seeing any resurgence in that?
I think that's still playing out right now. I have been out talking to a few of the groups here in town. And I would say that we had probably an oversupply going into this. There was mad dash in. I think there's going to be a little bit of a shakeout. There already has been with some of the companies. Some of the models just didn't work, and it was just an expedited to failure for some of those businesses. But the ones that are really going to thrive, like here in Boulder, like Kiln on the east end of Pearl, they have quick access to the outdoors. It's a single level, plenty of open space for people to go into. And so I think the ones that are really going to thrive have the best locations and the access to the outdoors. So yeah, we are going to see some of those go away though.
Yeah. One thing I've always said is Boulder has not lost its appetite for good food. So once we're all more comfortable sitting in a restaurant next to each other, I truly believe that our dining environment will come out of this better than it was. It might take a year for us to get there, but new concepts, new ideas will take over where old spaces were. We're all eager to go out and eat dinner with our friends.
Yeah, no doubt about it. And I just think in general across commercial real estate, Boulder's so well positioned to come out of this faster than almost any other markets. There's a handful, and Boulder's definitely one of those. So I think we're really well positioned to do well. It's just some of the asset classes like office may take a little bit longer for everything to shake out, but we're already seeing it happen on some of the other asset classes.
Right. That's fun. Are you seeing landlords still incentivizing tenants, or are they sort of projecting forward now, saying that are they back to their old terms, or are they still giving months free rent, additional tenant finish kind of stuff?
Yeah, I think we're still seeing that, not across the board. Industrial, certainly not. It's just as usual. Office, we are seeing landlords that are being a little bit more accommodating to get people into their buildings with the hope that they'll probably be there for the long run. So a little bit more flexibility, whether it's on rate or, abatement on the rent, or just a more flexible schedule to get people in. And I think that's probably smart for the next, 6 to 12 months to get, tenants in there that could be long-term tenants. So that's a smart play. But, as I said, on retail, there was some of those transactions happening, but that was a little bit earlier on. And now it's sort of right back to where it was. So maybe there's a few months, or the first 6 months, there's a little bit of reprieve, make sure the business is up and running, really looking as a business partner for the landlord. But then the growth schedule is back to pre-COVID numbers pretty quickly thereafter.
Yeah. Well, that's great. That's super interesting, Scott. I have to say, I was very curious as to what your comments might be.
Yeah, it's not all doom and gloom. I'm glad I'm not doing this business in downtown New York or San Francisco. Certainly glad that our business was, here in a place like Boulder.
Yeah, I would mirror that comment.
Yeah.
I think all of us would, for many reasons. Yeah. Okay, well, moving on. I know in the residential space, obviously, everybody asks what spurred all this real estate activity. And of course, it's the pressure from the bi-coastal markets, New York, San Francisco, LA, parts of Florida, parts of Texas. That has been a main contributor, especially at our high-end market. But I think a secondary contributor has been everybody locally started to reassess their housing needs. All of a sudden, either out of, empty nesters had boomerang kids that came home, or all of a sudden everybody's kids are at home in school, and both parents now need offices in home. So we've seen a lot of people sort of reshuffle the deck locally because of the evolving needs of their living situation. So one of the things, our next guest is Adrian with Melton. And my real question to him, on two folds, is what have they seen on the construction end? Because I know what I've seen on the sales end, and I'm curious whether there's consistency amongst that. What have they seen from their clients' demands? And then we'll talk a little bit about cost of construction and supply chain and the issues and the challenges that they faced. But Adrian, if you want to just sort of take it from there.
Sure. Thanks, Steve. I'm glad to be a part of this roundtable. So yeah, I think most of the people on this call, the industry was a little scary. We had about 1 month, March, April-ish, where the phone just stopped ringing, and we were all staring at the governor's mandates like it was my kids watching or reading Harry Potter. I remember one night up at like 11 o'clock waiting for that update to see if we're going to be considered essential. And luckily, remodels, residential remodels were always considered essential. So that was one box that was checked, so we could still keep doing work. Now the next question was anyone going to be interested in having us come into their house and remodel their kitchen or build a new home? And like I said, we had 3-4 weeks where the phone slowed down significantly. And as a company who's been around Boulder for 30 years, and we have about 50, 60 mouths to feed that are primarily Boulder County residents, it got a little scary. And then it just started going a little bonkers, where the phone started ringing off the hook. And frankly, it hasn't really stopped since then. And it's pretty obvious. People are, they're stuck in their house a lot more. That pink backsplash is a lot more offensive to them than it ever was. and they're also have a little bit more cash on hand, and they're not going out to dinner. That $10,000 Hawaii vacation is now, not part of their plans. And so they really started thinking more about what they need out of their home, and picked up the phone, and Melton's been happy to help them out with that. And part of your question that you had introduced was, what are the needs? Are the needs of homeowners changing? And that's been a really fun and interesting, part of this whole equation is, and in twofold, you've got people want to have connection to nature, big accordion doors that they can open up their house, and they can make the outdoors a little bit more of a extension of their kitchen or living spaces, so that they can maybe do some level of entertaining without feeling like they're stuck inside. And with Boulder's temperatures, we get a lot of that just as of 3 days ago, you can tell. And so you've got people wanting to be outdoor and get fresh air, connection to nature, and then you layer that on top of what Noel and Scott and yourself, Steve, have already commented on, is a lot of people are leaving the coasts who are used to having wide open floor plans and being able to feel connected, having a accordion, a Nana window or Nana door out looking towards the ocean or some nature. And so we are seeing that connection to nature a lot, really big landscaping plans. And then you're right, every basement's being finished because mom and dad, everyone, the homeowners are now being forced to work from home. We're doing a ton of quick offices to get people organized and being able to operate at a high level. And then, Boomerang Kids, we had a lot of projects where we were going to remodel a kitchen and a bathroom, let's say, and suddenly we switch gears because their 2 kids are coming back from college and they need some space for them. So it's been interesting, but it's been a lot of fun.
There was an article, Adrian, in the New York Times a long time ago that said the open floor plan is dead. And I disagreed with that article. And the reason they said the open floor plan is dead is now that people are wanting to be sequestered in their own space. Their kids are locking themselves in their bedrooms, and their comment was we are now all living together, but we all want to live a little separate. It sounds like that you're reiterating my belief that the open floor plan is not in fact dead, that people are still looking for that concept. Is that true?
I think it's actually somewhere in the middle. The way that I usually explain it to clients, especially when they're looking at a new home and I'm coming out to help assess what that home might be able to be from a design standpoint and a budget standpoint to do the remodel. I always say from cavemen to like the 80s and 90s, we had very compartmentalized floor plans. The kitchen had 4 walls, the living room had 4 walls, the dining room had 4 walls. And then it switched completely. The pendulum went to the opposite side, where we are just nothing but open floor plans. From a structural foundation standpoint, that's relatively easy, especially with the technologies that have arrived. And now I'm seeing that kind of pendulum land somewhere in the middle, where, because open floor plans, when you're trying to cook the Thanksgiving meal and you got a hot mess and you're burning the potatoes, the whole world is right in your business. The whole world can see it, and that's not fun. Plus the noise level, the kids running around, it just echoes everywhere. And then you've got art placement. A lot of our clients in Boulder, they're art collectors, or at least they have a couple of pieces and they need somewhere to hang that art. And then furniture placement can also be a little complex when there's no walls to put the sectional couch up to. So I'm seeing it land somewhere in the middle. Mm-hmm. And you want what I usually say is semi-compartmentalized. You want a couple of walls to break up the space and bring the noise levels down a little bit, yet you still want the space to feel as big as it can. Yeah. And so, I think it's somewhere in the middle. I'd agree it's not dead, but it's just been revised slightly.
So segueing away from that, there obviously was a big topic of conversation has been the cost of construction and supply chain issues. Can you speak to a bit of what you've seen and where you anticipate that going? And are we actually going to normalize from a construction cost perspective?
Yep, great question. So let's hit supply chain lines first. And so you're right, there was some pretty major disruption. You know, the cabinet company in Omaha now has to go to 50% capacity. And so they're churning out, you know, half as many cabinets as they expected. And so the lead times, things that usually would take a month or two, are now taking, still to this point, are taking twice as long. Any good contractor understands that and isn't going to demo the kitchen until they know exactly when the countertops are going to arrive or the cabinets are going to arrive, so that we don't demolish half your house and then sit for a month while something's coming in. So that's a pretty easy workaround. There's a few things. Anything coming from overseas is still taking a lot longer than it should. But again, that's in most part become either normalized, or any quality, any sophisticated contractor can make amends with that and figure a way out of that. The trouble is right now still is the construction cost. And it's funny, Scott joked with me yesterday about, hey, Adrian, when are you going to get these construction costs to get lowered? And, you know, really I'll position the same question. Hey, when are you guys going to get residential real estate prices lower? And they certainly mirror each other in a lot of aspects. It's just supply and demand. And so all the trade partners throughout Boulder County are, you know, drywall and painters and plumbers and mechanical and electricians. They're all just really busy from this influx of people buying homes who want to remodel them. And so, you know, I'm not seeing that end anytime soon. You know, as a company like us, we've had to reach out. We're tapping into Fort Collins. We're tapping into maybe even Colorado Springs, because some of those places that weren't as affected by everyone, the influx, maybe have a little bit more realistic pricing. And so we're battling that. You know, as a company, we're trying to actually absorb some of those costs so that we're not passing them on directly to our clients, but it's difficult. And so we're getting multiple bids. You know, we've got a very intimate trade pool of people that we like to work with, and we're expanding that a little bit to make sure that we are getting as competitive bids as possible.
Yeah.
And then you've got, so that's labor cost and a little bit of strain there. And then you've got material cost and lumber, as most of you will know, lumber doubled in 4 months, which is never since, I think it was like 1920, have we ever seen an increase in pricing that significant in lumber. That's been the biggest one. Steel has gone up. I've been on the phone with a bunch of different lumber yards, and we're seeing that level off. And then the next question is always, okay, will it go down? And I'd say, much like Boulder real estate, you don't really ever see it go down. We all just become a little bit normalized to it and become kind of normal. It just feels, you know, okay, a house in Lafayette's $400K. That's weird. It was $200K 6 years ago. And now it's $700K, and now it's $800K. And so we kind of get a little bit more acclimated. But I'm anticipating a few material costs to go back down to reality, and labor to go back down to the norm. But as it's gone up and then it goes back down, and then we just have annual increases in pricing. So I wouldn't expect it to ever go down unless there's something major, a major recession. Then we might see it, but that's also the same time that nobody really wants to do, you know, throw $100,000 into their house during the middle of a recession unless there's a good reason. So.
And it's interesting, as I hear you saying this, I can't help but think that our industries are dovetailed with each other so well, because the alternative to buying an existing house is remodeling or building. And the residential real estate world, when construction costs get real high, all of a sudden purchasing what you know, instead of remodeling or building, purchasing starts to become more viable, and the two of them kind of play off each other. So it's an interesting tipping point between the two. I've had many clients go through that discussion of, do we build or buy? And largely it's related to construction costs.
Yep.
So
I do the same thing.
Costs go up, ours do too, because they relate. Yeah.
Yep. I have the exact same experience where people ask me to come out to the house. They've got all these dreams of what they want to remodel in their house because they love the school system and they got friends in the neighborhood. And then I usually shatter their dreams, unfortunately, and say, okay, well, here's how much it's going to cost to do all of these things. Then they go, all right, maybe we'll just sell the house. Then they call one of you guys up. You shatter their dreams a little bit with, what's the Boulder County real estate market and how tough it is these days. And then either they buy or then they call me back up and say, okay, let's prioritize what we need to get done now. And we come up to an appropriate solution.
Right. That's fascinating. Okay. Anything more to add, Adrian, or shall we move on?
Feel free to move on.
Okay. Okay. So, and before we get to it, our next section is we're going to get to questions. If anybody has any, if you have questions, please feel free to either raise your hand or put them in the chat function. And each of the respective, whoever it relates to, will be happy to answer them. But before we do that, I just want to talk about charity and our charitable partner. So, it's funny, in the typical real estate cycle, realtors aren't really going to closings. There's less interaction with clients. I've always been committed to charity as a concept and committed to giving back to the community that we all work in. And I feel like that has slowed during the pandemic, largely because we don't have face-to-face gatherings. There's no, golf tournaments, bike rides, gala events, all of that stuff has sort of ceased to exist. So the exposure is getting harder for charities. And I would be honest and say that because of my lack of closings, I sort of let some of my charitable contributions slide simply because I did it as a little bit out of every closing I would give to a various charity partner. So as part of this, and I'm going to try and do this periodically, we're going to make a commitment. My group is going to make a commitment to make a monthly charitable contribution, just a culmination of all closings that might happen. We'll make a monthly charitable contribution, but also in addition to that, to whenever we do one of these real estate roundtables, to have a charity partner. So this round's charity partner is the Davis Phinney Foundation for Parkinson's. And I don't know if all of you are familiar with that. If you're not, you should be. It's a wonderful organization that's located right here in Boulder. Connie and Davis are landmarks of our community, and both tremendous athletes in their own respective ways. And they also happen to be wonderful friends and a great couple. So they, the Davis Phinney Foundation, and Connie, if you feel like chiming in, please do. I know you're on the call, but the thing that I really appreciate about the Davis Phinney Foundation is that their mission isn't necessarily to cure Parkinson's. They leave that to someone else. Their mission is to make sure that the people that are living with Parkinson's are living the best lives possible. And I think that often cure gets highlighted and quality of life gets neglected. And this is one instance where I really believe they do an amazing job. I've been a supporter of theirs for a very long time now and a friend of theirs. So I am going to make a charitable contribution to the Davis Phinney Foundation after this call is done. And I would encourage, if anybody else feels so compelled, there's a little QR code. I think that's what it's called.
Oh, that's so cool. I haven't seen this on a Zoom before, Steve.
I know, we're pretty fancy. And
That's awesome.
if you would like to scan that QR code, or Connie, maybe you can reflect on where people can make that contribution and how people can help. That would be great.
Well, yeah, thanks so much, Steve. I appreciate the attention for the foundation today. And I wanted to kind of weigh in on the market report for foundations. I have to tell you that it actually has been a good year. And I think maybe it's that we've had more time at home to reflect on some of us on our good fortune, and also on the fact, as some of you also noted, that we haven't spent as much money because we're no longer going out to dinner. We're no longer taking these big trips. And so fundraising has been good. It's been up, especially since we pivoted really quickly. Right at this time last year, we pivoted to all virtual events. We increased our educational offerings by about 500%. And because so many of the doctors, the neurologists, were actually not on the front lines and had more time, and they weren't traveling as they had before, we were able to get more experts on our Zoom webinars and calls, and just were impacting just just 100 times the number of people that we normally impact with much more current and up-to-date information. We had more time with the doctors. They would take questions in a format just like this. And it's really been phenomenal. I think we've improved the lives of so many people this year in a way that we had never considered would be possible. So everything you do, Steve, to support us and the rest of you, it makes a big difference. The money is helping to employ, we have about 20 people on staff actually now in our educational and development side of things. And although everybody's been mostly working virtually and doing it really successfully, we continue to grow. So donations are happily accepted at davisfinneyfoundation.org or .com or dpf.com, and much appreciated. I think it's been a big time for everyone to reflect on just how lucky we are. And I was very terrified early in this process for the people in the Parkinson's community, but for the most part, I hate to say it, but most people with Parkinson's are more isolated than the average American. And so we probably were able to isolate easier. Didn't mean that it was in the long run the best thing to be doing. But, Steve, we run into you and we're out on our bikes, and we're thankfully able to do all that. And Davis and I just got our first vaccine shot this week too. So
Good for you.
I feel normalcy coming back.
I do too. Well, thanks, Connie. Much appreciated for everything you do. And also, so if there's one thing we've learned from this, it's that all of our houses are worth more and you can borrow cheap money, and that you should give a little bit of it away. So,
and we promise to spend it well. I'm telling you, we have the best staff in place, and we're just, our roots are really deep in this community, right, Noel? I've known Noel since he was a teenager.
That's right. I used to mow your lawn.
Yeah. So funny, right?
Yeah.
Anyway, but we appreciate being included. And I think that, we are, the beauty of America is how much we're willing to give. No matter what the rest of everything costs out there in the world. I mean, yeah, Noel, you have people complaining about the interest rates or whatever. It's like, there's a lot of people with a lot of money and a lot of great intention. It's just absolutely fantastic. And I appreciate that so much in the philanthropical side of what we do. We just had an event. It was a virtual event with 6,000 people globally.
wow.
And we raised $385,000, $10 at a time, because people buy raffle tickets while they're participating in this spin event daily for a week. So, you know what? It's like anything is possible in this world, and we'll just keep at it. And wish Davis could be on the call today, but he's actually at the foundation. So.
No, that's great. That's great. Well, that's the wrap up of our formal part of our presentation. I'll just make one comment on, I just had a little thought on looking forward, because I think everybody might be curious. We talked a lot about the past and what the expectations are looking forward. My sentiment personally is that I feel like, obviously, hopefully the pandemic, we're right around the corner from normalcy, but I've never been more bullish on the Boulder as a community and as a real estate market. I've never been more bullish than I am today. I think there's new industries. One thing that Scott had reflected on was all the growth in these different sectors. And one thing that I found is that whenever we see growth in any, tremendous growth and intellectual equity coming to Boulder, we get a lot, not only just Google moving here, or when Crispin Porter Bogusky moved here is a great example. They moved here, 10, 15 years ago. And there was probably 5 ad agencies in Boulder when they moved here. Now there's probably 25, and probably 15 of them are spinoffs from Crispin Porter. And I think we're going to see that in all of these different respective fields. There's a lot of really smart people that companies like Google are bringing here, and many of them are gonna grow into something else. They're gonna create another startup or some other great idea. So I've never been more bullish on Boulder's market. I think the high end especially is where I'm focusing most of my optimism, even though I think, the market will buoy itself across all segments. So I think we're in for really great days ahead. Yeah.
I would second that, Steve, on the commercial side too. I've never been more bullish on the Boulder market and the Colorado market for commercial real estate as well. And we have more transactions going on over the past 2 quarters than we ever have.
Yeah. We all made a wise decision to move here whenever we chose to make that decision. Yeah. Noel was the smart one. He got here first. Okay, well, I guess we'll open it up if anybody has questions. I think, no, if you don't, no problem. We are not offended if we've answered every one of your questions. But if you do, feel free to do so now, and we'll just stick around for a couple of minutes. But thank you to everybody that participated.
Hey, Steve, this is Megan.
Hi,
Are you
Megan.
going to do another one of these?
Yeah, that's our goal. This was the test of it. So I hope everybody enjoyed it. And the goal is to do several of them.
Thank you.
Yeah. Anybody else with questions? If not, we'll sign off. Okay. That sounds great. Thank you very much, everybody. And we'll all talk soon. Hopefully in person.
Thank you, Steve. It was awesome. I appreciate
Thanks,
it.
Steve.
Thanks, guys. Much
Thank
appreciated.
you.
Bye.
Yes.
Bye.
Yeah, thanks. Bye, everybody.
Bye, everybody.
Bye.